Now, as you can see, the US government holds about $36 trillion in Treasury bonds. The number is so large that a floor-to-ceiling pile of $100 bills will reach the moon and return many times. Over the past decade, every politician, every cable news expert, every economist with a Twitter account has been shouting that number, calling it unsustainable, warning of the fiscal cliff, and predicting a collapse of the dollar. Yet no one tells you what really matters. The US government doesn't have to pay its debts. It doesn't have to do what you think. It doesn't have to do with your mortgage. It doesn't have to do with your credit card bill. There is a mechanism, a quiet, almost invisible strategy, that has been deployed in American history, and there are strong signs that it is now being redeployed. Once you understand how it works, the way you think about the reality of money, savings, investment, and purchasing power changes forever. This is documented monetary policy, with names, histories, and written records. At the end of the video, you'll learn exactly how it works, who benefits from it, who is destroyed by it, and what you can do to make sure you're on the right side of the equation. Most people, even those who think they have financial knowledge, misunderstand how US government debt actually works. When politicians stand on the podium and say, "We need to pay our national debt," they either deliberately mislead or really don't understand the system in which they operate, which should worry you either way. The comparison you often hear is this: if a family manages its budget the way the government does, they go bankrupt. That sounds logical, responsible, and completely wrong. When you borrow money to buy a home, you must repay it in roughly the same dollar value as the dollar you borrowed. Your income has to grow, or you cut back, or you default. These three options are all you have. The US government has a fourth option, which you will never have. It issues debt denominated in currencies. The United States borrows in dollars and is the only entity on Earth that can create dollars. This does not mean that it can print money directly without any consequences, which we will see, but it means that the traditional debt repayment framework does not apply to the way most people think. By the beginning of 2025, the national debt had exceeded $36 trillion, and the annual interest payment of the debt exceeded $1 trillion. For the first time in history, that is more than the entire defense budget and more than Medicare spending. Interest on debt has become one of the largest single items in the federal budget, a trajectory that the Congressional Budget Office predicts is accelerating under current policy. The real question is, if debt is so big and growing so fast that interest payments alone consume a growing share of the budget, what is the specific plan? The answer, the real answer, not the answer you hear in your campaign speeches, is so-called financial repression. Financial repression. The term came from the economists Edward Shaw and Ronald McKinnon as early as 1973. But the concept goes far beyond that. At the heart of financial repression is a set of policies that governments use to redirect money to themselves at below-market rates, effectively allowing them to borrow cheaply while eroding the true value of debt over time. No policy works alone. The beauty of a combination of tools that often last years or even decades, from a government perspective, is that most people never realize it is happening. Playbook has 4 components running together. First, keep interest rates below inflation, which is the cornerstone of the whole strategy. When you put money into a savings account or buy a Treasury bond that pays 3%, and inflation is 4% or 5%, you lose purchasing power every year. Your nominal balance rises and the number in your account gets bigger. But what that money actually buys shrinks. You feel like you're making money, but you're actually going backward. The entities benefiting from such arrangements are borrowers. If I owe you $1 million, and inflation erodes the value of that $1 million by 4% a year, the real burden of my debt will be reduced, and I won't have to pay an additional amount. Now, expand that number to $36 trillion. The second component involves creating an exclusive domestic audience for government debt, which means that regulations, rules, and incentives effectively force financial institutions, such as banks, pension funds, and insurance companies, to hold government bonds. After the 2008 financial crisis, regulations like Basel III required banks to hold larger reserves of safe assets, which effectively meant government bonds. When banks face regulatory requirements to hold treasuries, they become built-in buyers, whether or not yields actually compensate for their inflation risk. This demand is structural, not market-driven. The third component is controlling capital flows, which can range from subtle regulatory pressures to outright capital controls. In the current environment, it appears in ways that most people don't notice, such as reporting requirements for overseas accounts, restrictions on cryptocurrency transactions, and tax penalties for moving funds overseas. The goal is to keep capital at home, to keep it available, to keep it within the system, and to allow it to flow directly to government debt. The fourth factor is moderate but persistent inflation, the one that ties everything together, not hyperinflation, not the kind that causes social unrest or dominates the evening news. As long as it is hot enough and long enough, the real value of debt melts like ice on a warm sidewalk, slow enough for most people to adapt, fast enough for it to drastically reduce the real debt burden in a decade or two. Here is the thing, these are neither theories nor predictions. The United States has done that, and with remarkable results. After World War II, the United States faced a debt-to-GDP ratio of about 106%. Fighting the most expensive war in human history has pushed national debt relative to the economy. As we are today, the conventional wisdom is that the government must have started some large-scale austerity programs, slashing spending and raising taxes to reduce that figure. Not really. In fact, it was a textbook case of financial repression that lasted from about 1945 to 1980. The Federal Reserve cooperates with the U.S. Treasury Department to artificially depress interest rates through yield curve control policies, literally limiting government bond interest rates. First, through a clear agreement with the Treasury Department, and then through implicit policy choices. During this period, the average real interest rate on government debt was negative. Inflation-adjusted interest rates on U.S. government debt have been below zero for decades. Carmen Reinhart and M. Bellan-Sprancia documented this in a landmark 2015 paper, Government Debt Liquidation. Their research shows how the combination of negative real interest rates and moderate inflation clears up a large part of the debt burden in the United States. And through their calculations, financial repression effectively solves the problem of debt worth 3 to 4% of GDP per year at its peak. In about 35 years, the ratio of debt to GDP fell from 106% to about 35%. What really matters? There was no default, no hyperinflation, no dramatic fiscal consolidation. It happened slowly, quietly, and almost invisibly. While the economy grew and most Americans lived lives that never realized their savings were being gradually diluted, Britain followed the same pattern after both world wars, as did France, Italy, and almost all other major economies that emerged in the mid-20th century. With huge war debts, financial repression is the standard strategy. And it has succeeded because it is so politically attractive today. This is an implicit tax. No votes, no protests. There is no bill in Congress called the Let Us Eat Into Your Savings Act 2025. It happens only in the context of the interaction of monetary policy, regulatory policy, and inflation. Now let's bring this to this point. Because if you keep paying attention, really paying attention, the signals are everywhere. Start with real interest rates. Even after the Fed's interest rate hike cycle from 2022 to 2023 raised the federal funds rate to a range of 5.25% to 5.5%, the actual impact on savers is not as dramatic as the headline implies. For most of 2023 through 2024, CPI inflation was between 3% and 4%, meaning that the real rate of return from paying 5% for high yield savings accounts could be 1 to 2%. That is better than negative real interest rates in the post-war era, of course. But here is where things get interesting. The interest rate cut began in September 2024. By early 2025, the federal funds rate had fallen, and the Fed's signals showed that further interest rate cuts were still under discussion. At the same time, inflation has proved sticky, surprising many economists. It did not fall back to the Fed's 2% target. Instead, it hovered and stayed high in services, housing, insurance, and the categories that hit ordinary Americans hardest. This means that the gap between nominal interest rates and inflation has narrowed again. Real interest rates are shrinking, and if the Fed continues to cut while inflation remains above target, we are going backward to a negative real interest rate system. Then look at the issuance of Treasury bonds. Janet Yellen, Deputy Treasury Secretary, made a thoughtful decision in 2023 and 2024 to shift a larger share of government borrowing to shorter-dated notes rather than longer-dated bonds. This is important because short-term bills have lower interest rates. By issuing more short-term debt, the government has reduced direct interest payments. Critics call it financial engineering. And they're right. Managing the debt burden by manipulating the maturity structure is a conscious choice, which also means that a larger proportion of debt is rolled over more frequently, which amounts to an implicit bet that interest rates will fall in the future, making refinancing cheaper. If you're a government expecting a low interest rate environment in the future, that is what you're doing. The regulatory environment illustrates the same. Since the banking turmoil that followed the collapse of Silicon Valley banks and several other regional banks in March 2023, regulators have doubled down on requiring banks to hold high-quality liquid assets, mainly government bonds. The proposed Basel III final rule, while challenged by the banking industry, will push more Treasury bonds onto bank balance sheets. This creates structural demand for government debt, independent of whether yields actually compensate investors for inflation risks. Banks are not buying treasuries because they represent a big deal. They bought them because the regulatory framework left them with no choice. Here's a question that most people don't notice at all. What happens to nominal GDP? Growth relative to borrowing costs. This is the variable that really drives debt sustainability. If the nominal growth rate of the economy is 5%, which means real growth of about 3% plus 2% inflation, and the government borrowing rate is 4%, then even if the government runs a deficit, the ratio of debt to GDP will naturally improve over time. Debt growth is slower than economic growth. Basic algorithms. But it is algorithms that determine whether the debt burden is sustainable. For much of the post-pandemic period, nominal GDP growth in the United States exceeded the average interest rate on outstanding government debt. This is the quiet part, where the real work is done, not through deep budget cuts, not through tax increases, but through simple but relentless mathematical calculations that growth exceeds borrowing costs, and inflation is a big burden on the growth side of the equation. Now let me add another layer, because it is 2025. And if we don't talk about trade policy, we'll ignore the elephants in the room. The Trump administration has reintroduced aggressive tariffs. including broad-based tariffs on Chinese imports, targeted tariffs on steel and aluminum, and threats to universal benchmark tariffs. The stated goals include protecting American manufacturing, restoring jobs, and reducing the trade deficit, all of which may or may not be achieved. But a secondary effect of tariffs is that, in this context, few people are connecting. Tariffs are inflationary in nature. A 25% or 50% tariff on imports would push up prices for American consumers and businesses, directly affecting overall price levels. Now, if you are a government sitting on $36 trillion in debt, and your quiet strategy is to let inflation erode debt over time, tariff-driven inflation is not an unnecessary side effect. This is a feature. It offers a politically satisfying explanation for rising prices. We have achieved our monetary goal of keeping inflation above borrowing costs while protecting American workers. I want to be clear. I'm not saying the tariffs were imposed to inflate debt. Policy motives are complex and hierarchical. But whatever the intent, the effect is the same. Higher prices have pushed up nominal GDP. The denominator of debt to GDP has grown faster, and the real burden of debt, the trillions of dollars of debt actually represent in purchasing power, is shrinking. At the same time, there is a fascinating dynamic between interest rates and tariffs. When the tariff escalation unsettles bond markets, fleeing to safety depresses Treasury yields, effectively reducing the government's borrowing costs. The policy uncertainty created by aggressive trade measures can reduce interest payments on debt in an unusual way. Chaos was created, and borrowing became cheaper, as panicked investors poured into treasuries as a haven. Everything we're talking about is impossible without one factor: the dollar's status as the world's reserve currency, something most people don't fully appreciate, as the US dollar is the main currency used in global trade, central bank reserves, commodity markets, and international financial contracts. There is an inherent demand for US dollar-denominated assets, especially U.S. Treasury bonds. Foreign central banks, sovereign wealth funds, and international institutions hold trillions of dollars in U.S. government debt. According to the latest data, foreign holders hold about $7.5 trillion to $8 trillion in Treasury bonds, a huge captive group that is difficult to diversify from dollar assets without disrupting their own economic and financial systems. This creates a dynamic worth pondering. The United States can continue to run deficits and issue huge amounts of debt, but it can't still find willing buyers. Because the alternative is that a world without enough safe assets in dollar terms is worse for all concerned. China holds more than $750 billion in treasuries, not out of a love of lending to the U.S. government, but because trade relations generate huge dollar surpluses that need to be parked somewhere, and no market on earth is deep enough or liquid enough to absorb these flows, other than the Treasury market. That is how it relates to financial repression. When a global captive audience needs to hold your debt, whether the actual return is positive or negative, you can keep real interest rates depressed for much longer than otherwise possible. Foreign holders absorb inflation losses, as well as domestic holders, and in many cases they absorb even more, because currency fluctuations can magnify or exacerbate erosion of real returns. If the dollar weakens and inflation erodes the real value of Treasury holdings, foreign investors will be hit in both directions. There are real questions about how long this will last. De-dollarization is a real conversation going on in the global financial community, with both China and Russia trying to do more trade in their currencies. BRICS countries talk endlessly about creating alternatives. But as of early 2025, The reality is that the dollar's share of global reserves has fallen from about 72% in 2000 to about 58% today. A meaningful shift in 25 years. But 58% still represents overwhelming dominance. There are no viable alternatives. The euro has structural problems associated with the eurozone's decentralized fiscal policy. The renminbi is not freely convertible, and China maintains capital controls. Encryption is still too unstable and too small to work. The dollar's position has weakened marginally, but it remains the foundation of the global financial system, which allows the United States to impose financial repression on a scale that the rest of the world cannot try. Now let's talk about what really matters to you and your money. Because financial repression has winners and losers. And if you don't understand which side you're on, you're almost certainly on the loser's side. The losers are savers, people with cash. A person holding a large balance in a savings account, money market fund, or certificate of deposit. People on a fixed income. Pensioners living on pensions have not fully adapted to inflation. Anyone whose wealth is mainly denominated in nominal dollars. Third, understand that debt is good for you, not bad for you. If you can borrow at a fixed rate below expected inflation. The 30-year fixed mortgage rate is 6.5%, while the actual borrowing cost is less than 2%. And the average inflation rate over the life of the loan is 4 to 5%. For more than 3 decades, this advantage has been greatly exploited. I'm not talking about reckless borrowing. I mean, cheap fixed-rate debt is a tool of financial repression, not just a burden. Fourth, observe the signal. Track real interest rates. Not nominal interest rates, but real interest rates. Look at the gap between your savings income and real inflation. Focus on the Fed's remarks about inflation targets. If you hear things like average inflation targeting, flexible inflation targeting, or allowing inflation to overheat for a period of time, that is the quiet part. Just a little louder. The Federal Reserve adopted the average inflation target in August 2020 and never formally abandoned the framework, telling you in academic terms that inflation above the target is tolerable. Listen to what they're actually communicating. Fifth, think about your sources of income. In an environment of financial repression, inflation-adjusted income, whether through job changes, career promotions, corporate ownership, or inflation-linked contracts, is a priority. Fixed income flows lose purchasing power due to design. Variable income, equity-based compensation, and business profits that can be repriced as cost levels rise represent your ability to withstand erosion. Let me leave this for you. Treasury bonds will not be repaid. In the traditional understanding of this phrase, we will not, and probably never will. No politician balances budgets, runs surpluses, and writes checks to bondholders until the balance is zero. It has always been a fantasy. The only really important question is how to manage the debt burden. And the answer, as history has shown and implemented in real time before us, is that it will be swept away by inflation. Take your time, quietly. In a way most people never fully understand. It is not inherently evil. The post-war financial repression coincided with one of the greatest periods of economic expansion and middle-class prosperity in American history. As the economy boomed, debt faded. This strategy can work, but the price is for people who don't know the game. At the expense of savers, fixed-income retirees, and anyone who holds wealth in nominal dollars and believes the system can maintain purchasing power. Its core is the transfer of wealth from lenders to borrowers, from people who hold cash to people who hold assets, from people who are financially unaware to people who are financially knowledgeable. Now you know. How you handle this information is entirely up to you. If failure gives you something of value, click the subscribe button to open the notification. Because we do this deep mining every week, and no one else connects you. Put your thoughts in the comments below. Because I've read it. And given what we just reported, I'd like to know what you're doing with your money now. See you next time.